Welcome to the deep dive. Today we're taking a close look at the Enterprise Investment Scheme, EIS. You've probably heard about it, the way the government uses tax breaks to push investment into growing UK businesses. Well, EIS is often right at the center.
It really is. And we're going to unpack the specific qualifying conditions, the rules that govern it.
Exactly. We're using source material from my pensions advisor here, which provides info to help make sense of these, let's be honest, pretty complex financial areas.
Our mission today is really to cut through all that detail.
Yeah, give you a clear picture based on this material of what kinds of companies and what sorts of investments actually qualify for EIS relief.
Think of it like getting the blueprint for what the government sees as an eligible growing business that's worth private investors taking a risk on.
And understanding these rules isn't just for people thinking of investing, right?
Not at all. It's pretty essential if you're just interested in how scale-up funding actually works here in the UK.
Okay, let's dive into that blueprint then. Where does it start? How do we figure out if a company even qualifies?
Well, the material lays out some fundamental requirements for the company itself. One of the very first things it mentions is that the company has to be unquoted when the EIS shares are actually issued.
Unquoted. Okay, does that mean it can't be listed on any stock exchange at all?
That's a good question. The source clarifies this. It can't be on a main market, like the London Stock Exchange, but companies listed on AIM, the alternative investment market.
AIM.
Yeah, they are treated as unquoted for EIS. That's a really key point.
Interesting. So AIM companies can qualify. And the material mentioned something about a rule change here historically.
It did, yeah. It notes that before March 7th, 2001, the company had to stay unquoted for a whole relevant period.
Right.
But the rule got a bit less strict after that. Now it really focuses just on the moment the shares are issued. The crucial thing now is just that there aren't any arrangements already in place for it to stop being unquoted right after the shares are issued.
Okay, so unquoted when the shares are sold with that AIM exception and no immediate plans to list. Got it. What about what the company actually does, though? Its purpose?
That's the next big one. The company has to exist wholly to carry on one or more qualifying trades. Or, alternatively, it could be a holding company that just holds shares in the subsidiaries that carry on those qualifying trades.
So if it's a holding company structure, the actual work, the qualifying trade, has to be happening down in the subsidiaries.
Precisely. And for a subsidiary to count as qualifying here, the parent needs to own more than 50% of its ordinary share capital. The source also points out that when you're looking at the group's overall business for the qualifying trade test, things like just holding or managing property within the group don't count towards that test.
Okay, so the core business activity, whether it's direct or via majority-owned subs, has to be a qualifying trade. We'll need to dig into what that means exactly in a minute. But first, company scale. Are there limits on size?
Oh, absolutely. There are limits on gross assets and also on employee numbers. And these really give you a strong sense of the kind of company EIS is targeting size and stage-wise.
Right. Walk me through those asset limits first.
Okay, so the gross assets limit is £15 million. That's immediately before the shares are issued.
15 million before.
And then it can go up to 16 million after the share issue. The source does mention that historically these limits were lower. Back between 2006 and 2012, it was more like 7 million and 8 million pounds.
But I think I saw something about knowledge-intensive companies, KICs.
Yeah.
They get higher limits.
They do, yes. For KICs, that post-issue limit is higher. It's 20 millions in gross assets.
Okay.
And the material also brings up limits on the total amount of funding a company can raise under schemes like EIS, VCTs, and similar risk finance schemes.
Right, there's an overall cap. What is that?
Yeah, the total lifetime limit for all that risk finance combined is 12 million.
12 million total.
But again, higher for KICs, they get 20 million pounds. And there's also a separate, much smaller lifetime cap specifically for CEAS investments, that's the Seed Enterprise Investment Scheme, for really early stage startups, that's 250,000 pounds.
So companies can't just keep raising unlimited funds through these schemes forever?
Exactly. And importantly, the source highlights an annual limit too. This applies to how much they raise under EIS, VCT, or CEAS in the 12 months leading up to a new EIS investment. Since April 2012, that annual limit is 5 million pounds.
And what if they go over that 5 million in a year?
Well, the material is pretty stark on this. If that annual limit is breached, none of the shares in that specific EIS share issue will qualify for tax relief.
Wow, none of them. That's quite a harsh cliff edge.
It really is. Suggests HMRC takes that annual cap very seriously. And before 2012, that annual limit was only 2 million pounds, so it was significantly boosted.
Okay, so we have asset limits, funding caps, What about people, employee numbers?
Yep, there's a limit there too. Since April 2012, the company, or the group, if it's a group, has to have fewer than 250 full-time employees, or, the equivalent in part-timers. That's at the time the shares are issued.
250. And that was lower before, too.
It was, yeah. Before April 6, 2012, the limit was only 50 employees.
So another limit that's increased, potentially widening the net for eligible companies.
Yeah.
And I assume KICs get a higher employee limit as well.
Exactly right. KICs can have up to 499 employees.
Okay.
So if you pull all these limits together, the assets, the funding caps, the employee count, you start to see the picture, right? The scheme is really aimed at companies that are past that initial seed stage that's more safe territory, but still definitely in a growth phase before they get too large or established.
That definitely helps frame the target company size. What
Yeah.
about age? Is there a limit on how long the business can have been around?
Yes, there is. Generally speaking, EIS relief isn't available if the company's been trading for more than 7 years. This really underlines that focus on growth, supporting companies earlier on.
7 years? Are there ways around that? Exceptions?
There are a couple of important ones the material points out. If the company has already raised money under EIS or VCT or CEASE before,
Okay.
that can allow it to qualify, even if it's technically older than 7 years. And also, if there's been a really fundamental change in what the business does, that can effectively reset the clock, too.
Got it. And KICs, do they get longer?
They do. 10 years instead of 7 for knowledge-intensive companies. So, yeah, all these rules together really define the company's basic eligibility, its size, its stage, its maturity.
Okay, so let's say a company ticks all those boxes.
Mm-hmm.
It unquoted, has the right purpose, fits within the size and age limits. What happens after the investment comes in? The rules also cover how the money has to be used, don't they?
They certainly do. The material explains the money raised has to be used for what's called qualifying business activity, and the timeline for actually using that money, well, it's tightened up over the years.
How so?
Well, before April 22nd, 2009, the rule was a bit more staged. You had to use 80% within 12 months, and then the other 20% within another 12 months after that.
And now, what's the current rule?
Since that date in 2009, the rule is much clearer. All the money, 100% of it, has to be wholly employed within 2 years of the shares being issued.
2 years.
Or if the qualifying activity hasn't actually started yet when the shares are issued, then it's 2 years from when that activity begins. It means companies need a pretty solid plan for putting those funds to work relatively quickly for growth.
2 years for all of it.
Yep.
Yeah, that sounds like quite a commitment. So what exactly counts as a qualifying business activity?
According to the material, which references Section 179 of the Income Tax Act 2007, it generally means one of two things: either carrying on an existing qualifying trade or preparing to carry one on.
Okay.
And that trade has to be wholly or mainly in the UK. If they're just preparing, the trade actually has to kick off within 2 years of the share issue.
Right.
The other main activity is research and development, R&D, as long as it's intended to eventually lead to a qualifying trade.
And didn't the material mention something historical about oil?
It did, yeah. A bit of a historical quirk. Before March 7th, 2001, oil exploration that was intended to lead to a qualifying trade also counted. But that specific activity isn't a qualifying use anymore.
Okay, so the money needs to be spent fairly quickly on the main business or related R&D in the UK, which brings us back to the core idea of a qualifying trade. How does the law actually define what is a qualifying trade?
This is where it gets, well, quite interesting and maybe a bit backwards from how you might expect. Instead of listing all the trades that do qualify, the legislation defines it mainly by listing a whole load of trades and activities that do not qualify.
Defining by exclusion.
Ooh, that's
Sounds very legislative, doesn't it?
Yeah.
So what's on this blacklist then? What kind of things can an EIS-backed company not be primarily involved in?
It's quite a broad list, actually. Generally, it rules out a lot of financial and sort of passive activities. For instance, dealing in land, dealing in commodities or futures or shares, securities, other financial instruments.
Right, so no speculative trading.
Exactly. Banking, insurance, other financial activities are out too. And dealing in goods is excluded unless it's just normal, ordinary wholesale or retail distribution.
Okay, so no banks or insurance firms. Standard goods distribution is okay, but not other types of dealing. What else is excluded?
Leasing activities are generally out. Receiving royalties or license fees, those passive income streams are excluded too. Property development is a definite no.
Property development, okay.
And quite a few primary industries are also on the non-qualifying list.
Yeah.
Farming, market gardening, holding or managing woodlands, forestry, timber production.
Right, so things related to land use, primary production, passive income like royalties, generally out.
Precisely. Hospitality accommodation is another specifically excluded area. So, operating or managing hotels, guest houses, hostels, basically anywhere offering overnight stays, or even just managing property that's used for that purpose.
That seems quite targeted. Hotels and similar places are out.
Yes, and it's similar for care homes. Operating or managing nursing homes or residential care homes, or managing property used for that, that's also non-qualifying.
Healthcare property management also excluded. What about service businesses? Are they okay?
There's a restriction there too, yes. You can't provide services or facilities to another business if that other business is doing a non-qualifying trade and if the same person effectively controls both businesses.
Oh, like a linked company arrangement.
Exactly, and this applies if the service provision is considered substantial.
What does substantial mean here? Is there a percentage?
The material suggests that while it's not rigidly defined, HMRC generally takes substantial to mean around 20% or more.
Okay, so you can't just use EIS funds to set up, say, a management company that primarily serves a non-qualifying hotel business you also control, if those management services are a big part of the hotel's operation. Is there anything else on the exclusion list?
Just one more specific one mentioned. Subsidizing electricity generation through certain government schemes, specifically contracts for difference or renewables obligation certificates relating to things like anaerobic digestion or hydroelectric power.
You. Okay, that is quite an extensive list of exclusions. So the qualifying trade is basically whatever's left over. Active trading businesses that are involved in those specific areas like finance, property dealing, certain land-based industries, hotels, care homes, or those specific service energy situations.
That's pretty much the practical result, yes. The scheme is clearly steered towards active trading businesses and sectors not on that prohibited list.
Okay, so we've covered the company needing to be the right type, size, age, and doing the right kind of trade and using the money correctly. But are there things that could stop an investor from getting the tax relief, even if the company itself seems fine?
Yes, absolutely. The material flags up conditions related to specific arrangements that might exist before or at the time the shares are issued. Essentially, the scheme is meant for genuine risk capital.
Right.
So anything that looks like it removes that risk up front can disqualify the investment for that particular investor.
What kind of arrangements are we talking about?
Things like pre-existing arrangements for the investor to sell their shares soon after, or arrangements for the company to sell off its main assets, or even arrangements for the company to just stop trading shortly after the investment.
Basically, ways to get the money back quickly without real risk.
Exactly. And crucially, any kind of arrangement that effectively guarantees the shareholder's investment or gives them some kind of protection against loss that would also make the investment non-qualifying.
That makes complete sense.
Yeah.
If you've already sorted your exit or your money's safe, it's not really a risky growth investment anymore, is it?
Precisely. The whole point is backing ventures where the investors are genuinely putting their capital on the line. The material also mentions a couple of changes that came in around late 2015.
Oh, yes.
Like new restrictions stopping existing shareholders from just claiming EIS relief on new investments in the same company quite so easily. And also preventing companies from using EIS funds simply to acquire another existing business.
Right, sort of tightening things up, maybe closing potential loopholes, or making sure the funds really go towards organic growth, not just buying other companies. And we touched on the overall funding cap earlier, that 12 million or 20 million for KICs.
Yes, that total cap is a key ceiling. It limits the total amount a company can pull in through EIS, VCTs, and other similar state-aided risk finance schemes over its lifetime.
Okay, let's shift gears slightly. Let's talk about the timeline for the EIS scheme itself, and also this relatively new condition called risk to capital.
Right. Well, originally, the Finance Act from 2015 put a sort of sunset clause on EIS and also on VCTs. It meant that relief would only be available for shares issued before April 6th, 2025.
Which, until recently, was starting to feel quite close.
It really was, yeah. Created a bit of uncertainty. But then a really significant update came in the autumn statement on November 22nd, 2023.
What happened?
The government announced a major extension for both EIS and VCT schemes, a full 10 years.
10 years, wow.
Yeah. So they are now set to continue running from April 6th, 2025, right through until April 6th, 2035.
That's huge, a decade-long extension. That provides a lot of certainty, surely, for investors and companies planning ahead.
Absolutely. It's a massive vote of confidence in the schemes and really solidifies their place in the UK's economic strategy for the foreseeable future. Now, alongside that long-term view, there's this risk to capital condition you mentioned. This came in for investments made on or after March 15th, 2018.
Okay, risk to capital. What does this actually require? It sounds like it's trying to make the risk element more explicit.
It is, yes. HMRC needs to be satisfied the investment meets this test. The material explains that, looking at the situation when the shares are issued, it has to be reasonable to conclude two key things.
Two things. Okay, what's the first?
First, that the company genuinely intends to grow and develop its trade over the long term. That ties back into the purpose rules we discussed earlier.
Right. So it must be about real long-term growth ambitions. What's the second part?
The second part is that there must be a significant risk that the investor could suffer a loss of capital,
A loss of capital.
and that potential loss needs to be greater than the overall net investment return they might expect.
Significant risk of losing more than you might get back in total.
Okay.
What counts as that net investment return?
The source clarifies that. The net investment return includes basically everything the investor might get out of it. So that's the upfront income tax relief they claim.
Okay.
Any income they might receive from the company, like dividends, and any capital growth they might get when they eventually sell the shares.
Right. So you add up all those potential benefits, the tax break, dividends, profit on sale, and there still needs to be a real significant chance you could lose more than that total amount.
That's the essence of it, yes. The potential downside, the risk of capital loss, has to be significant when weighed against that total potential upside, including the tax relief. The material also points out this is assessed from the perspective of investors in general, not based on one specific person's tax situation.
And why was this test brought in? What was the aim?
The stated intention, according to the source, is to filter out what you might call artificial investments. Schemes where maybe the actual risk is very low, but they're structured primarily just to harvest the EIS tax benefits.
Ah, so trying to stop contrived tax planning schemes.
Exactly. It's meant to ensure the relief goes to investments genuinely backing risky, growth-focused companies. The material stresses it's not intended to penalize genuine startups or early-stage businesses, which obviously carry inherent risk.
Right, so it's a hurdle aimed more at those sort of capital preservation schemes dressed up as EIS. But that term significant risk, that's not actually defined with a number or percentage, is it?
No, it isn't given a precise definition in the legislation. It's described as something that needs to be determined on a case-by-case basis. It requires looking at the company, its plans, the market, the potential outcomes, making a judgment call at the time of investment.
Which does add another layer of, well, judgment and maybe uncertainty for companies and investors trying to be sure they qualify.
It certainly does. It really pushes the focus onto the genuine business proposition and the real level of risk being undertaken.
Okay, wow. We have definitely covered a lot of ground there, pulling all that detail from the My Pensions Advisor source material.
We really have. We've looked at those core conditions for the company itself, needing to be unquoted with that important AIM exception, having the right kind of trading purpose, fitting within those specific limits on gross assets, funding raised previously, and employee numbers.
And generally being within that age bracket, usually 7 years, but longer for KICs.
Exactly. Then we dug into how the investment money has to be used pretty quickly, within 2 years, and for the right kind of business activity.
Which led us to that fascinating list of things that are not qualifying trades. How eligibility is often defined by what's excluded across finance, property, farming, hotels, care homes, and so on.
And we touched on things that can stop an investor getting relief, especially those prearranged exits or guarantees that remove the genuine risk, plus those overall funding limits the company faces.
And finally, we highlighted the huge news about the scheme's lifespan being extended all the way out to 2035. And we broke down that crucial risk-to-capital test introduced in 2018.
Yeah, that test requiring both the intent to grow and that significant risk of losing more capital than the total potential return, including the tax relief itself.
Understanding this whole framework of rules really gives you, the listener, a much clearer picture of the specific blueprint the UK government uses to decide which growing businesses it wants to encourage private investment into using these tax incentives.
It shows you what makes the cut and maybe just as importantly, what doesn't.
Absolutely. And maybe here's something for you to chew on as we finish up thinking about all this. That recent decision to push the end date for EIS and VCTs out by a whole decade, all the way to 2035. What is that really significant long-term commitment signal about how important supporting these earlier stage, often riskier ventures through private capital is seen for the UK's economic strategy over the next 10 years? It feels like a very powerful statement about the intended role of these schemes, doesn't it?